Every month you trade, you check the balance and it's lower again. For a second, the number does not even surprise you anymore because some part of you already expected it. You are sitting there telling yourself, right, so I'll change something, a new indicator, a different time frame, maybe a tighter stop loss, and it feels productive. It feels like forward motion. But that adjustment isn't a fix. It's a reset, and you just sent yourself back to month one. You won't feel it happened. 6 months from now, the balance will look the same, and you won't understand why. Because every adjustment quietly erased the only trading progress that was building underneath. Now, here's what that actually costs you. It's not the money. It's sitting down after a red month, knowing that you've been at this for 6 months and you are telling yourself, I can't even tell if I'm getting better. And then the quieter thought underneath, what if I'm just not built for this? That frustration is what makes you change something again. Not logic, not evidence, just the need to feel like you are moving. And that need is the most expensive trading habit you own because it disguises retreat as progress. By the end of this video, you will have the 12-month trading map that shows you the exact month your trading losses stop outpacing your wins. Two traders start using the same strategy with the same account size and the same 30-minute daily window. After 12 months, one is profitable and the other has blown the account. But the profitable trader didn't start earning fast. For the first 6 months, the account looked worse. It was an evening in January 2017. I had my charts open at my desk. 8 currency pairs across the screen. I'd already taken a couple of trades that month, but it felt like nothing was happening. So I kept scrolling between pairs faster than I could actually read them. There has to be something in here. That thought came back almost every session, even the ones I'd promised myself I'd keep short. One more pair, one more scan, and every extra market I opened gave my brain fresh material to build a trading story around. A pin bar that almost qualified on one pair, a level that looked close enough on another. So I talked myself into it and take the trade, telling myself, well, it's close enough. And if it moves even half as much as the last time, I'm in profit. And then privately, the quieter thought, if I don't take this, I've just sat here for an hour with nothing to show for it. I'd open the charts with a plan to scan two forex pairs and close the laptop. 20 minutes later, I was from forex markets deep, building cases for trades that didn't exist when I sat down. The scanning itself was generating the signals, not the market. Not because the setups improved, but because my standards dropped every time I opened a new chart. Each extra market widened the pool of almost qualifying signals, and each signal gave me another reason to act. But the action was manufactured by the scanning and not by the market. By that point, I was tracking 8 currency pairs and averaging 5 trades a month when I should have been taking 2. My focus was spread across twice as many markets as I could properly analyze, and half my trades were setups I'd talked myself into rather than setups that genuinely passed my trading rules. Trading discipline costs nothing, but trading without it costs everything. Here's what took me that year to learn. A 12-month trading journey is 3 phases, and each one builds on the last. Phase 1 is the foundation. That is months 1 through 4. Phase 2 is calibration, months 5 through 8. And phase 3 is execution, covering month 9 through 12. But you can't be in phase 2 while phase 1 is incomplete. The phases are gates, and each one stays locked until the work is finished. I call them phase gates. Phase 1 has 3 milestones. First, a written trading plan specific enough that a stranger could execute it. Not guidelines, rules. If the trend is up on the weekly, prices pull back to the major daily level, and a pin bar forms, then buy. Any condition missing means do nothing. Second, a back-tested sample of at least 30 trades proving a profit factor above 1.4. Profit factor is your total gains divided by your total losses, and most traders never calculate it. They spend months trading a system that was never profitable to begin with. So they are losing on a strategy that couldn't even win on paper. And third, a fixed trading risk rule. 1% per trade, every trade. This is the difference between surviving your first trading losing streak and being finished by it. I don't believe in overnight trading success. The traders who reach profitability build something boring in months 1 through 4. And the ones who skipped are the ones who quit. 3 green ticks: plan, proof, risk rule. No green ticks, no phase 2. So you've got your 3 green ticks. But passing the phase 1 gate does not mean the account starts growing. And what happens next is the reason most traders quit. It has nothing to do with their strategy. Your best trading months will feel like your worst. Not the months where you lose money, but the months where nothing happens at all. The account flatlines, the trading journal stays empty, and every instinct says the strategy is broken. Most traders change something when this happens, but the ones who reach profitability don't. In 1983, a commodities trader named Richard Dennis made a bet with his business partner. Dennis believed profitable trading could be taught, but his partner believed it required innate talent. So Dennis recruited a group of people with no trading experience, gave them a specific trend following system with the exact rules of entries, exits, and position sizing, and handed them real money to trade. He called them the turtle traders. They all learned the same system, the same rules, and the same risk management. And within 2 years, the results split. Some turtles made fortunes, others barely survived. And the difference wasn't their talent or intelligence, it was what they did when the system went quiet. The successful turtles took every signal their rules generated, even during losing streaks, even when weeks passed with nothing to trade. They sat in silence and waited. The unsuccessful turtles started skipping signals during drawdowns and forcing trades the system hadn't generated, because doing nothing felt like falling behind. You can almost hear what they were telling themselves. Maybe I missed something. Maybe the rules need adjusting. And then the private thought underneath: everyone else seems to be trading. If I'm just sitting here, maybe I'm the one who's wrong. The system hadn't changed. The rules hadn't changed. But the traders who couldn't tolerate quiet months broke the only thing that was working. That quiet stretch between valid trading signals is the dead zone. And most traders never reach profitability because they interpret trading silence as failure, and hence they start making noise. Here is what the dead zone is quietly building. A trader who's wrong 60% of the time with a 2-to-1 risk to reward still nets about 6% across 30 trades. The edge isn't in the strategy. It is in the 30 consecutive executions without deviation. Phase 2 has 3 more milestones. Number 4, 30 consecutive live trades scored on trading process only. Did you follow the plan? Yes or no? Your trading balance is irrelevant. Number 5, a simple compliance tally tracking how often you followed your own trading rules, and you need it averaging above 80%. Number 6, 0 revenge trades, not even one. Win rate is vanity, but risk to reward is sanity. If anyone tells you that you need to be right most of the time to make money trading, they have not done the maths. The phase gate for phase 2 is 3 more green ticks. Without them, phase 3 does not exist. You've got the first 8 months of the map. You know the phase 1 milestones, and you've seen what the dead zone looks like. Now try to score yourself. Phase 1, milestone 1. A written trading plan specific enough that a stranger could execute it. Do you give yourself a green tick or a red cross? Most traders freeze here, not because they don't have a plan, but because they can't tell if their plan is specific enough to count. Misdiagnosing your phase sends you backwards through a gate you thought you'd passed, and you probably won't catch it on your own. That's what this 3-minute diagnostic quiz in the description below identifies before you spend months building on a trading foundation that isn't there. It doesn't ask what you know, it asks what you do. You'll find the link to access it below. But our trading map is not complete. There's a specific month inside phase 3 when something shifts, and what triggers it is not what you expect. The month your trading losses stop outpacing your wins is not the month your wins start increasing. It's the month your losses shrink. That distinction changes everything about how you prepare for it. In 2003, British cycling was so far from competitive that a major bike manufacturer refused to sell them equipment, afraid that association with them would damage sales. Then Dave Brailsford took over and introduced what he called the aggregation of marginal gains. The idea that dozens of tiny improvements, each one barely noticeable on its own, would eventually stack into something massive. He did not recruit faster cyclists or overhaul the training program. He redesigned the team pillows for better sleep quality, painted the inside of the team's track white so mechanics could spot dust that might affect maintenance. None of those changes made anyone pedal faster on their own. And for the first few years, the big results hadn't arrived. Other teams spent millions on altitude camps and wind tunnels, while Brailsford's team tested pillow fabric. And the pressure to abandon the small changes for something dramatic was enormous. He stayed. Within 5 years, British cycling dominated the Olympics. Within 10, they won the Tour de France. The gains were always accumulating, but they just did not show up until enough of them stacked. Every green tick on your trading map that does not move the balance is a marginal gain the scoreboard cannot see yet. Phase 3, months 9 through 12. By month 8, every phase gate was passed in sequence. Your trading losses have now quietly changed shape. The stop losses that were once too wide are now calibrated with ATR, the average true range, which measures how the market actually moves rather than relying on guesswork. The setups you used to force have stopped appearing in your trading journal because the compliance tally made the cost visible. None of those changes individually flip the account, but together, around month 8, the losing trades that were large become small, and the maths finally has clean data to work with. That's the flip month, not the month you become a great trader, the month you stop being a destructive one. Milestone number 7, your profit factor across a live 30 trade sample is above 1.4, not in a backtest, in real money under pressure. So if it's below 1.4, your phase gate is telling you to go back and find the leak. The 8th gate tests something different. Your full trading process from scanning to journaling, fitting inside 30 minutes without rushing and without checking back. If it doesn't fit, you are carrying steps that aren't earning their place. And the final milestone is the hardest. You've survived at least one trading losing streak of 5 or more trades without changing your strategy, your risk, or your routine. Trading losing streaks are not bugs. They are a feature. The trader who survives one without flinching is the trader whose maths compounds from month 9 onwards. Guaranteed monthly trading returns are guru fairy tales. The numbers show up when the trading behaviors are clean, not before. So print this map, all 9 milestones across 3 phases. Tick it on the wall, stick it on the wall. Every Sunday, score yourself, green tick or red cross. Did you complete the milestone? Yes or no? Miss a Sunday review and you restart your current phase from week 1. Because a green tick you gave yourself to feel productive is worse than a red cross. It hides a crack in the trading foundation. 7 days at a time, one phase at a time. Mark your calendar for next Sunday because that's day 1, and every week from here, you answer one question. Am I green or red on my current phase? The trader who reaches month 9 with 9 green ticks is not someone who got lucky. That's a trader who earned every quiet month between here and there. And profitable trading does not feel like winning. It feels quiet, just the absence of noise. I mentioned the first milestone, a written entry rule specific enough that a stranger could execute it. Try writing yours right now, in your head. If the trend is up on the weekly, then what? That pause between seeing the setup and knowing whether it qualifies is the gap most traders never close. You are sitting in it right now. That's the terrain the map does not teach you to navigate. This next video gives you the 60-second setup filter that turns that pause into a clear yes or no. The filter will fill the silence. So see you in that video.